The top business stories live from the Sky News City studio. Government borrowing is higher than expected as interest payments on the national debt hit a monthly record. A big media merger potentially on the cards as the chief executives of Warner Brothers Discovery and Paramount Global meet for talks. And Hypnosis, which owns the rights from songs from Lady Gaga to Blondie, suspends dividend payments as losses widen. Good morning, this is Business Live with me, Ian King. We begin with some breaking news concerning one of the UK's best-known restaurants. That news comes, of course, courtesy of our city editor, Mark Kleinman, who joins me now. Mark, what have you got?
Yeah, that's right, Ian. This concerns Richard Caring, the restaurateur who's become arguably the most successful figure in Britain's high-end restaurant industry. What I understand today, Ian, is that Mr Caring has appointed investment bankers to explore a sale of a controlling stake in the Ivy, which analysts believe could be worth up to £1 billion. Now, Mr Caring took control of the Ivy's parent company, Caprice Holdings, back in 2005. And as I understand it, he's expanded it so successfully in recent years that he now believes the time is right to potentially cash in on that. So he's appointed HSBC to advise him on a process that will run during the course of next year. Now, to be clear, Mr Caring, who is a major figure in the Mayfair premium entertainment scene, is not going to be selling his private members clubs, which include Annabelle's, George and Mark's Club in Mayfair. He's also going to be keeping hold of some of his other restaurant assets, which include Scott's and Jay Sheikey. But as I understand it, he is serious about potentially offloading a majority stake in the Ivy collection in the new year, and that could value the business, as I say, at up to £1 billion.
Great stuff. Thanks, Mark. The UK government borrowed more than expected last month as interest payments on the national debt hit a monthly record and the cost of benefit payments rose. The Office for National Statistics said the government borrowed £14.3 billion in November. That was more than the £12.9 billion the city had been expecting. It was actually down £900 million on November last year, but was nonetheless the fourth highest November borrowing since monthly records began in 1993. Well, the ONS said interest payable on the government debt during the month was £7.7 billion. That was up £100 million on November last year and was the highest November total since monthly records began in April 1997. Benefit payments during the month came in at £24.2 billion. That was up £1.2 billion on November last year, reflecting inflation-linked benefits uprating and cost of living payments. Borrowing so far during the financial year came in at £116.4 billion. That was up £24.4 billion on the same 8-month period last year. Well, joining me now is Alison Ring, Director of Public Sector and Taxation at the Institute of Chartered Accountants in England and Wales. Alison, welcome to you. I mean, government tax receipts were up quite strongly during the month, but so too was spending.
Yeah, I mean, the gap to the 8 months of to November 2023 is £116 billion. That's, more. Obviously, we're borrowing more than we're actually, getting in. So it's a terrible state of affairs, really.
It's interesting is that, of course, this time last year, the government was supporting households with their energy bills, and yet the numbers seem to be worse on some measures than that.
Well, even without that, you've got the doubling of the interest charge for the period, and actually at the end of November, the public sector net debt is going to be approaching £2.7 trillion. And even as an accountant, I can't fathom what that means. And that's actually about £95,000 worth of debt per household.
Sums of money. Where does this leave the Chancellor, do you think, in terms of his headroom for possible tax cuts ahead of the general election?
I think he's got some very difficult decisions to make because you've got deteriorating public sector services, yet he wants to obviously constrain the spend on those. You haven't got a growing economy. And what we really need to be doing is investing in infrastructure and investing in our public sector services so that effectively in the long term we spend less money.
Of course, I guess had the Office for Budget Responsibility not revised its numbers at the time of the autumn statement, it would look, these figures wouldn't look so bad by comparison.
I'm not so sure. I think they still look a bit appalling, really. And if we were managing our own household debt in that way, I don't think we'd be too happy, would we?
Quick word on taxation, Alison. I mean, tax receipts were up very, very sharply. I mean, the magic of fiscal drag is certainly working for the Chancellor.
That's right, because the thresholds for personal tax haven't actually gone up. So obviously more people are being brought into the system. More people are having to do self-assessment returns. Not sure if that's the answer. There's a lot of cliff edges in the system, in the tax system, which might be constraining growth as well. So lots to think about for the Chancellor.
OK, got to leave it there, Alison. Appreciate you joining me this morning. Thank you.
Thank you.
Now, if you're a retailer, regardless of whether you're a physical retailer or online only, your priority for Christmas shopping season is the right products in the right place at the right time. And that also applies to those whose products are being sold. Well, supporting both types of businesses is DHL Supply Chain, part of the German-owned DHL Group and the world's largest logistics company. Joining me now is Saul Resnick, Chief Executive of DHL Supply Chain for the UK and Ireland. Saul, welcome to you. What are you seeing right now across your operations in terms of inventory?
It's been an interesting time. So it feels like Christmas has come a little bit later than we thought it might in some areas, in some industries. Our retail, big format retail, is pretty flat year on year. And so that's whatever growth we have seen is primarily price driven as opposed to volume driven.
Right.
The areas that have picked up is our convenience and forecourt business. Certainly we're seeing double-digit growth there. So it feels like shoppers are spending less money but more frequently. More convenient, obviously. What's interesting also is the pub trade has been quite flat year on year, probably 4% down. We do a lot in
the what trade? The
pub trade.
Pub trade, so,
yes.
Yeah.
But what we've seen in the last 2 weeks specifically is that there's been an increase in volume there, almost to pre-pandemic levels from a food and hospitality side.
Goodness.
Beer volume still a little bit flat, but the last week or two are promising. So hopefully they'll have a good Christmas in that regard.
It's interesting because, I mean, there is a lot of anecdotal evidence to suggest that workplace parties are back this year for the first time really since the pandemic.
It would appear that way. I mean, if you go out and about, as I was last night in the city, it does feel like a lot more people are out and about doing that. So hopefully that's a sign of a little bit more of consumer confidence coming into the market. And perhaps with what we've seen now with interest rates perhaps capping out and inflation coming down, a little bit more consumer confidence coming into the market, which will bear well potentially for 2024 and beyond.
Yeah, very interesting what you say there about volumes of inventory, though. Is that what you would have modelled given what's been going on with inflation?
What we have seen is post-pandemic, a whole bunch of changes have taken place from a supplier perspective, and companies are becoming a lot smarter in their supply chain management. They're doing a lot more omni-shoring as opposed to reliant on one source of supply. So there's a lot more resilience in the supply chain. So what we're not seeing this year is haphazard supply of product. There's a lot more predictability in the actual supply. What we have seen, obviously, is that demand hasn't always met that supply requirement throughout the year. But hopefully, as I said, the last couple of weeks are a good indication that things are picking up a little bit.
Now, obviously, we've got this unfolding situation in the Red Sea. A lot of the big container shipping companies are having to reroute their vessels. How concerned are you about that?
Again, less concerned than I would have probably been a year or two ago from a supply chain predictability point of view. Companies are doing better at multi-shoring or omni-shoring, so they're getting supply not just from one strategic source. Because if the pandemic taught them anything, that to be overly reliant on one supplier is fraught with challenge. But it is a challenge, there's no question, and we'll see how that plays out.
Are there particular lines of goods or products that are more vulnerable to this kind of thing than others?
It's hard for me to say that at this stage. We're not seeing anything. It's still early days in terms of the Red Sea challenges. So perhaps in a few weeks' time we'll be able to predict that a little bit differently. But as things stand, no, it wouldn't appear that way. And
closer to home, the UK government yesterday set a target for increasing the amount of rail freight by 75% between now and 2050. How achievable is that in your view?
We've got a long way to go. We're still a very road freight reliant region. And to transfer from where we are from a road freight to rail freight will take a lot of effort. I think it's a noble cause. But there's a lot more stability and predictability required on the rail freight network before we can get to those kind of volumes. But, you know, it's good to have those aspirations.
Yeah, God loves an optimist. Saul, got to leave it there. Busy time of the year for you. Thanks for joining us today.
My pleasure. Thank you.
Some other business news stories for you now. And shares of media and entertainment stocks are expected to rise on Wall Street this afternoon following reports that the chief executives of Warner Brothers Discovery and Paramount Global met earlier this week to discuss a possible merger. A combination would bring together two of Hollywood's so-called Big Five movie studios, as well as bringing together some of the best-known names in entertainment and media. Warner Brothers Discovery owns CNN, HBO and the Discovery Channel, while Paramount owns MTV, Nickelodeon, Comedy Central and the CBS broadcasting network. Shares of Toyota fell by 4% today after the car-making giant announced a recall of 1.1 million Toyota and Lexus vehicles in the United States amid concerns over issues involving airbag-related sensors. The vehicles were made between 2020 and 2022 and have sensors which may not have been made properly, meaning the airbag may not be triggered in the event of a crash. Well, the recall comes a day after Toyota's Daihatsu subsidiary halted shipments of all its vehicles after admitting that collision safety testing for some of its vehicles had not been carried out properly over a period of more than 3 decades. The music rights owner Hypnosis Songs Fund has suspended dividend payments for at least the end of the current financial year after reporting a widening of losses. Hypnosis, which owns the rights to songs by artists including Barry Manilow, Neil Young and Blondie, reported an operating loss before tax of $63.6 million for the 6 months to the end of September. That was up from $17 million in the same period last year. The share's currently off by some 1%. And Cooperative Bank said today it had entered exclusive talks with Coventry Building Society with a view to a possible merger. Confirming a story first broken earlier this month by Sky's Mark Kleinman, Co-op Bank said it had received a number of non-binding proposals from potential buyers before deciding to talk to Coventry to better evaluate the merits of a combination. Coventry, the UK's third largest mutualised lender after Nationwide Building Society and Yorkshire Building Society, had reportedly submitted an offer for the bank, valuing it at more than £700 million. Well, after last night's reverses on Wall Street, during which the S&P 500 suffered its biggest one-day percentage fall since September, there was mixed trading for stocks in the Asia-Pacific region. The Nikkei in Tokyo fell by more than 1.5% from the near 33-month high it reached on Wednesday. Well, in Europe, the main stock indices are currently, that's the Nikkei, as you can see, they're off just over 1.5%. In Europe, I think we can show the continental European indices. Here they come, any second. Yeah, they're all in negative territory right now. Although one gainer to mention notably, talking points this morning include Juventus. The share's up in Milan by 7.5%. That's after the European Court of Justice ruled UEFA and FIFA had abused their positions by forbidding top football clubs to form a European Super League. Well, in London, the FTSE 100 also in negative territory, currently off 0.5% in a broad-based sell-off. Burberry is the leading blue chip faller. That's amid ongoing anxiety about the luxury goods sector. That's off nearly 3.5%. To the upside, Vodafone's ahead by just over 2% on supportive broker comment. Number of stocks have gone ex-dividend today, of course. In other words, they're trading for the first time without rights to the latest payouts. They include British American Tobacco, Halma and United Utilities. If you own those, don't worry, that's just because they've gone ex-dividend. That's why they're lower this morning. On the foreign exchange markets, after all the excitement stirred up by the inflation data yesterday, it's a little bit quieter today. Sterling up 0.25% against the dollar, off by 0.1% against the euro. The single currency up by 1/3% against the greenback. As for the oil price, well, that has traded in a very narrow range this morning. Barrel of Brent crude currently down by 0.2%, changing hands currently at $79.38 a barrel. Well, joining me this morning is Rachel Winter, partner at Killick & Co. Rachel, good to see you this morning. What a strange day it was yesterday on Wall Street. I mean, we've had this sort of great 9-day winning run for all the indices and then pop, evaporates.
Yeah, shame to see such a negative day and shame to see UK markets following suit this morning. I think really what we've got here is a bit of profit taking. Markets have had such a good year so far, and even after yesterday's fall, the S&P 500 is up 22% for this year so far. The Nasdaq Composite is up over 40%, so an incredible year so far. I think perhaps investors have got a bit overexcited about the prospect of rates coming down next year. That's why markets have come up so much, but I think it is wise to perhaps take a few profits at these levels.
Yeah, we were talking yesterday to people sitting where you are now about the fact that some central bankers might have to start jawboning the markets lower a bit in case they get too carried away with expectations for rate cuts.
Yeah, and you've already seen that. So you've already seen Andrew Bailey saying rates might not come down as early as people think. So I completely agree that the jawboning has started, as you say.
Now, one piece of news that's caught your eye today is the Lloyds Bank Business Barometer.
Yeah, so this is a survey that reviews about 1,200 businesses on a monthly basis, and really it's looking at how confident these businesses are feeling. I think this is something that's quite important to look at because investor confidence in UK businesses has been so low for the last couple of years, and we can see that by looking at the performance of the AIM index. That's lost nearly half its value since 2021. This Lloyds survey, which happens on a monthly basis, it had shown quite a nice increase in confidence last month. However, the latest figures that came out today did show a little bit of a drop in that confidence, and that seems to be as a result of the minimum wage going up after the autumn statement. So that does seem to be weighing on the minds of managers. So we'll just have to keep a close eye on that and see what happens there.
That is quite interesting, though, Rachel. I mean, I would struggle to reconcile that, though, with the latest PMI survey data that we got on Friday, which was remarkably positive.
It was, and there are so many surveys of this type, and that's why you can't put too much stock into one single survey. You have to look at all these different ones and just take an average of the lot.
Yeah, now, there aren't many individual stories around the market this morning, but obviously Hypnosis Songs, one of the market's walking wounded, continues to astound.
Yeah, so this is an investment trust that buys music rights and then it pays out the royalties to investors as an income stream. It's quite a new concept, so Hypnosis only launched in 2018. And at the time it was quite popular because interest rates were low and people really wanted income. But people have really moved out of it as interest rates in cash accounts have risen. And there have been a few problems with the fund. The latest issue does appear to be that the auditor and the board and the managers can't seem to agree on how to value what the business actually owns. And in fact, if you look at today's statement, the board essentially says we don't really have that much confidence in the valuation. And what's more, we don't have a good relationship with the investment advisor at the moment. So that is a concern. I don't think it's a surprise to investors, and you can see that by looking at the share price today. It's only down about 1%, so not a big shock to investors this morning.
All right, Rachel, got to leave it there. Good to see us ever this morning. Thank you.
Thank you.
Just a bit of breaking news to bring you. This comes from just over the road from here, actually, in the Old Bailey. Joshua Jakes, aged 29, has been found guilty of murdering his girlfriend and 3 members of her family in a drug and alcohol-fuelled knife attack at their home in South London. We will have more on that story in the next hour. But still to come here on Business Live, I'll be looking back at 3 decades of the city with the veteran FT journalist Jonathan Guthrie. You really don't want to miss what he's got to say. Stay tuned.
I'm Adam Parsons. I'm Sky's Europe correspondent based here in Brussels. Cobblers have been pulled up out and are being used as missiles to hurl at these police. Made by people who dare to challenge. Nice to see you again, Mr. Barnier. Why?
Meeting you.
Fishing does have the potential to stymie an enormous economic deal. We take you to the heart of stories that shape our world. What strikes you when you come to this glacier is not just the way in which the environment is changing, but the speed at which those changes are happening.
5 of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.
Slayemiyoruz. Slay better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, 1987 is remembered mainly in the city for Black Monday, the global stock market crash on 19th of October that year. But it was also the year that Jonathan Guthrie began his 37-year career as a financial journalist. He spent 31 of those years at the Financial Times, latterly as head of the paper's influential Lex column, but he's stepping down at the end of the year. And I'm very pleased to say Jonathan Guthrie joins me now. Jonathan, great to see you. You recently wrote a lovely column, What I've Learned in 37 Years of Financial Journalism. And you make a really great point that financial markets never seem to learn from their past mistakes. Why is that?
I don't think there's much incentive for them to do so, personally. If you think about an asset bubble, it creates lots of notional value. If you get a big bonus or a salary, you take that out as good hard cash. So there are lots of reasons for people to let markets rip.
And of course, there's also a high turnover of people. You know, the next crisis happens when the people who remember the last ones have gone.
Exactly so. I once had my plumbing fixed by somebody who'd been an up-and-coming FX trader.
Now, you also make, there's a great line in this piece. You say you never hear the bullet, the whistle of the bullet that hits you. What did you mean by that?
Well, this really came from the Queen, I think, asking economists, why did nobody see this coming, I think, after the crash that you mentioned. And I think that in other crashes, well, actually, no, that would have been the 2008 one, wouldn't it? In that case, I think people did see lots of crashes coming, but they were the wrong ones. So, for example, the Asian carry trade that was going on at the time, a lot of economists thought that was going to be a problem. It wasn't. It was something that nobody had foreseen in much detail, which therefore created greater panic.
Yes, absolutely right. It's great fun. I mean, there's lots of soul-searching going on in the UK right now about the future of the London stock market. I mean, you've been around a long time. Can you see it ever recapturing past glories?
I think it will, but it's going to take a while. My sense of it is that people talk a lot about rather fiddly market mechanisms, but it just feels to me like the market has lost its mojo a bit at the moment. There aren't animal spirits there that there were in the 80s or in previous rallies. It'll come back. Feels a bit more like the 70s to me at present.
Yeah, what would be the trigger, though, for those animal spirits coming back?
I think innovation, I guess, and the sense of possibility. We've lost that a little bit over recent years, and the terrible truth is that it may need memories to fade a little bit of things that have gone wrong.
Yeah, now talking of animal spirits, you also had a great line in this valedictory column about stock analysts being hedgehogs. What do you mean by that?
Well, this comes from an old idea that there are two kinds of people, hedgehogs who have one fixed conceptual framework and foxes who have lots of different conceptual frameworks. I think analysts are great, and I know lots of very smart analysts, but they tend to see things through the rather narrow pattern of the models that they create online. And that creates a kind of perceptual narrowing, I'm afraid.
Yeah, they do. Although, I mean, we should say there are some really, really good ones like Clive Black at Short Capital who do see round corners and aren't just tied up on their models.
Yes, no, that's fair, yeah.
You also, I mean, talking of animals, I mean, you do write the Odd Nature column for the FT as well. How did that come about?
That really happened during lockdown because a lot of people were beginning to relate to nature more. They were watching things in their garden, birds on their bird table, those kinds of things. I was too, and I started to try and write about it, really in terms of the animals that you see in cities and towns and suburbs. A lot of the time people think you need to go to the country. Cities and towns are great places for wildlife too.
Yeah, they really are. I mean, and that comes across in the FT's features content quite often. think the average FT reader looks like these days? I mean, obviously it's a digital-first product these days, immensely different from the organisation you joined.
I think it's a very mixed group across the world. A lot more of them are American than when I joined. We were a very, very UK-focused publication when I started. We would cover every result that happened on the London Stock Exchange. We're now very much more selective, and there's a very large component that is about the US and also Asia. To be honest, the US is where innovation is happening and where I think capitalism is moving forward.
Although it's changed quite a bit, because, I mean, Lionel Barber, one of your former editors, was obsessed with China to the exclusion of all else at one point.
Well, I wouldn't want to necessarily agree with that, but he was certainly very interested in China and Asia generally, I think also in Japan. And I think that was a little bit of a common obsession at the time, maybe. If you look at the attempts he made to woo China, George Osborne wanting the city to be a centre for the renminbi trade, the politics have changed very badly since then.
Yeah. All right, if you're watching Lionel, sorry about that. I've obviously done you a disservice. Jonathan, I get asked this all the time. Who's the most impressive CEO you've interviewed? Who's impressed you over the years?
It's probably going to be somebody who might be a little bit of a surprise to some viewers, because he was actually a CEO who had a very low profile. He didn't appear on many shows like this. You might have interviewed him, but he was Richard Cousins, and he ran Compass. And what I liked about him was that he was quite low profile, he was quite low-key, but he set a very good framework for everybody at Compass. He created a corporate culture, and a lot of growth came out of that. Very sadly, he and his immediate family died in a plane crash a few years ago.
Yeah, he was a great man, Richard. He never came on the programme, but he was the first to get in touch when it was announced I was joining Sky. Jonathan, great to see you, and best of luck for the future. Thank you.
Thank you very much, Ian.
Just before I go, a bit of breaking news for you. We understand that Hamas has just fired some rockets towards Tel Aviv. We will have more on that after this short break. I'll be back at 4:30 this afternoon. Hope very much to see you then. Do stay tuned. Breaking news coming from the Middle East. Jane Secker will be bringing it to you very shortly. Cheerio.